When we talk about the cloud or this relentless AI boom we're in, the language we use implies that it's all just weightless.
Right, yeah, like it doesn't physically exist.
Exactly. We upload these colossal data sets or we prompt an AI to generate a high-definition video out of thin air, and it feels like it all just happens, in the ether.
I mean, it is a brilliant illusion. The terminology itself, like cloud computing or wireless network, it's totally conditioned us to imagine this digital realm with zero physical footprint.
But the moment you actually step into the world of industrial power generation, that illusion just shatters. The cloud is not vapor.
No, not at all.
The cloud is made of reinforced concrete. It's forged from thousands of tons of steel, anchored by these colossal ocean wind turbines, and bound together by just hundreds of thousands of miles of high voltage transmission wire. Suddenly, you realize this weightless digital world has a very heavy, very uncompromising physical anchor.
It's basically the ultimate physical reality check for the digital age. We're witnessing an unprecedented collision between the boundless ambition of software and the rigid, unyielding physics of the electrical grid.
We are diving straight into that collision today on Talk Tickers. Our mission for this deep dive is to unpack a remarkably dense, very data-heavy source, which is the Dominion Energy, ticker symbol D, Q2 2026 earnings call.
Yeah, and it's a massive one.
It is. And for you, the listener, I want to clarify why we're spending time on a utility earnings call transcript. On the surface, utility earnings sound like the cure for insomnia.
Truly.
But this specific document, it's a crystal ball. It's showing us in real time the exact mechanisms of how the physical world is bending to accommodate the AI era. We're going to explore the granular, gritty realities of managing America's largest offshore wind farm, the high-stakes regulatory chess of a multi-billion-dollar corporate merger, and the sheer physics of keeping the internet turned on.
And if you're a retail investor holding Dominion stock, this document provides the architectural blueprint of our modern infrastructure. It's an unvarnished look at what it actually takes, financially and physically, to power the future.
The central tension here is the immovable physical grid versus the unstoppable force of artificial intelligence. Dominion can't just, wave a wand to conjure more electricity. They have to engineer it, finance it, and physically build it. Okay, let's unpack this. Let's start by looking at the financial foundation they're laying to survive this onslaught and the terrifying level of demand that's shocking their system.
The financials give us the necessary baseline to understand their capacity to build, which is crucial for investors. Management reported second quarter operating earnings of $79 million, which translates to 37 cents per share under GAAP, generally accepted accounting principles.
And before we breeze past that 37 cents, there is a tiny detail in those earnings that really caught my eye.
The RNG stuff.
Yeah, exactly. They specifically noted that this 37 cents includes 3 cents of RNG 45Z credits. For those not deep into the weeds of utility tax accounting, let's unpack what that actually means, because they aren't just selling electricity here.
No, they're not. That is a highly observant pull from the transcript. So the RNG stands for renewable natural gas, and the 45Z refers to the Clean Fuel Production Credit, which was created under the Inflation Reduction Act.
Yeah.
Utilities like Dominion have realized they can partner with agricultural facilities, like massive dairy farms, to capture the methane naturally emitted by animal waste.
Literally cow burps and manure.
Literally cow manure. They trap that methane, process it into pipeline quality natural gas, and burn it for power.
So instead of that methane venting into the atmosphere where it's this incredibly potent greenhouse gas, they're capturing it, monetizing the energy, and claiming a federal tax credit for reducing emissions. And that single mechanism generated 3 cents of earnings per share in a single quarter.
Precisely. It highlights how complex a modern utilities revenue stream has become. It's not just about, sending a bill to a homeowner anymore. It's about optimizing federal tax policy, environmental engineering, and complex financial structuring.
Speaking of financial structuring, despite the staggering capital projects we're about to discuss, management reaffirmed all their Q4 financial guidance. They reaffirmed their dividend and their growth targets.
Which retail investors always want to hear.
Right. But the metric that really matters for their long-term survival is their credit health. They pointed out that their FFO to debt metrics, funds from operations compared to their total debt, are sitting safely above 15% for fiscal year 25 in the last 12 months of Q2. Plus, their common equity program for 2026 is completely finished.
Yeah, that's huge.
Let me formulate a hypothesis here as someone looking at the stock. If that FFO to debt ratio slips below 15%, the credit rating agencies downgrade their debt, their borrowing costs spike, and their ability to finance the billions needed for this AI grid effectively collapses. Am I reading that right?
Your hypothesis is entirely accurate. That 15% threshold is basically the magic number for rating agencies like Moody's and S&P for a regulated utility of this profile.
Okay.
Funds from operations is essentially the pure cash generated by their daily business, if you ignore one-time accounting adjustments. If that cash flow cannot cover at least 15% of their outstanding debt in a given year, the debt becomes riskier.
And in a world where you need to borrow tens of billions of dollars to build ocean wind farms and new gas plants, a downgrade from a BBB plus to a BBB or lower means your interest rates just jump.
Exactly. You end up paying hundreds of millions more just to service the debt, which leaves way less money for the actual steel and wire.
Which is why completing that common equity program, meaning they've already sold the stock they needed to sell to raise cash for 2026, is such a critical signal. They're telling Wall Street, our balance sheet is fortified, we have the war chest ready.
And they desperately need that fortified balance sheet because the demand metrics they reported next are honestly nothing short of historical.
Yeah, the metric that really stuck out to me here, and I actually had to reread the transcript twice to make sure I wasn't misunderstanding the scale of this, came from the chief financial officer, Stephen Ridge.
Right, the peak days.
Yes. He stated that 9 of the top 10 all-time peak demand days for the Dominion Zone occurred this year. And the 8 highest summer peaks, they hit in just the last 2 months leading up to the call.
Just to contextualize that, consider the entire history of the regional electrical grid. Think of all the brutal heat waves over the last 50 years. To have 9 out of the 10 highest absolute demand days ever recorded happen in a single 12-month window. That represents a violent upward shift in the baseline consumption of electricity.
Let's talk about the physics of a peak demand day for a second, because the grid doesn't just naturally handle more power effortlessly, does it? Like when demand spikes that hard, the physical infrastructure is straining.
Absolutely. The electrical grid operates on a fundamental law of physics. Supply must exactly match demand at every single millisecond. There is no massive reservoir of stored electricity just waiting to be tapped.
Right.
When millions of air conditioners kick on simultaneously alongside these massive data centers, the frequency of the grid, which needs to stay perfectly at 60 hertz in the United States, starts to droop under the heavy load.
So it's kind of like a generator bogging down when you plug too many power tools into it. The engine just starts to struggle.
A perfect analogy. To prevent that bogging down, the utility has to instantly dispatch peaker plants. Usually these are expensive, fast-reacting natural gas turbines. They inject more supply and push the frequency back up to 60 hertz.
Okay, I see.
Furthermore, pushing all that extra power through the transmission lines causes the physical wires to heat up. When metal heats up, it expands, causing the high voltage lines to physically sag closer to the ground, which creates a whole new set of operational hazards.
Wow.
So managing 9 historical peaks in 1 year means the grid operators were fighting a constant high-stakes battle against thermal limits and frequency droop.
And the primary catalyst for the strain isn't just hotter summers, it's the data centers. The numbers Dominion presented are almost difficult to process. They currently have over 53 gigawatts of data center capacity in various stages of contracting.
It's an astronomical number.
12 of those gigawatts are already locked under firm electric service agreements. To put the velocity of this growth in perspective for an investor, they added 5 gigawatts of contracts, roughly an 11% increase just since the end of last year.
We really need to pause on that number. 53 gigawatts. A single large-scale nuclear reactor typically generates about 1 gigawatt of power.
Wait, so Dominion is looking down the barrel of adding the equivalent demand of 53 nuclear reactors to their regional footprint. The entire power grid of a medium-sized industrialized nation operates on less capacity than what these data centers are demanding from one American utility. Which begs the obvious question, why there? Why cram 53 gigawatts of insatiable demand into the state of Virginia? Management explicitly notes that customers are insisting their high-value AI training workloads absolutely must stay in Virginia. Why not build these data centers in the middle of a desert where land and solar power are cheap?
What's fascinating here is it comes down to latency and network density. Decades ago, a crucial internet exchange point known as MAE East was established in Northern Virginia. Over the years, telecommunications companies laid thousands of miles of deep, high-capacity fiber optic cables, and they all converge on that specific region.
Oh, I see.
Today, the Internet's central nervous system effectively runs beneath Loudoun and Prince William counties.
So if you're a tech giant training a multi-billion parameter AI model, the speed at which data travels through those fiber optic cables, even at the speed of light, actually matters. Being physically closer to that dense intersection of cables reduces latency by milliseconds, which translates to a massive competitive advantage.
Precisely.
Yeah.
They cannot move to the desert because the data pathways just aren't there. The ecosystem advantages, the physical fiber, the concentration of specialized tech talent, the proximity to federal agencies, all of that has made Virginia the undisputed global capital of data centers.
But if I'm a local resident or just a retail investor looking at the risk profile here, this sounds like a looming disaster. Dropping the equivalent of 53 nuclear reactors worth of demand onto the local grid practically overnight. If the utility has to spend tens of billions of dollars to build new substations, thicker transmission lines, and entirely new power plants just to feed these AI server farms, who pays that bill?
Yeah, that's the big question.
If I'm paying my residential utility bill, I am terrified of waking up to a 300% rate hike to subsidize a trillion-dollar tech company.
That is the defining regulatory anxiety of this entire era. The term for this fear in utility economics is stranded cost risk.
Stranded cost risk. Let me game this out. A tech giant comes to Dominion and says, we need a new $2 billion substation and a dedicated gas plant for our new AI cluster. Dominion borrows the money, builds the infrastructure, and bakes the cost into the rate base.
Right.
But 5 years later, the tech company decides a new quantum computing breakthrough allows them to process data using a fraction of the power. Or they decide to relocate to a different state, offering better tax incentives. They unplug the data center and leave. The infrastructure is now stranded. It serves no purpose, but the $2 billion mortgage still exists. Do the local residents get stuck paying off a ghost town?
That is exactly the scenario regulators are desperate to avoid. To prevent the local residents from holding the bag, Dominion employs what they call a large load framework. This is a bespoke regulatory and contractual structure designed specifically for these hyperscale customers.
How does the mechanism of that framework actually function?
It functions through aggressive upfront capitalization and ironclad take-or-pay contracts. Under the large load framework, Dominion requires the data center developers to fund the necessary local grid upgrades upfront.
Wow. Okay.
Yeah, if a new substation is required exclusively for that data center, the tech company pays for its construction out of pocket before a single server is plugged in.
Okay, so the upfront capital is covered. What about the long-term energy generation costs?
That is handled via minimum billing demands and long-term volume commitments. The contracts stipulate that the data center must pay for a massive baseline of electricity every single month for a decade or more, regardless of whether they actually use it.
Oh, that's wild.
If the tech company packs up and leaves in year 5, they're still legally obligated to pay the utility for power they promised to buy through year 15. This shields the residential ratepayer from the financial fallout of a tech exodus.
That protects the wallet, but what about the physical stability of the grid? Even if the tech giants are paying for it, plugging that much equipment into the network creates immense physical vulnerability. In fact, this was the crux of a brilliant question posed during the analyst Q&A by Paul Zimbardo from Jefferies. He brought up a recent transmission line fault on the Dominion system.
The incident he referenced was highly illuminating because it exposed a major vulnerability in how the digital and physical systems interact.
Right. What happened was there was a grid disruption, like a fault on a transmission line. Now, normally a data center has a massive array of backup systems, but during this specific event, the data centers failed to smoothly transition to their backup power, and servers literally went down.
To understand why this is so significant, we had to look at the mechanics of data center resilience. These facilities are designed with sophisticated, uninterruptible power supply systems, or UPS. A UPS is essentially a massive bank of batteries positioned right between the grid and the servers.
Because if the grid completely fails, a diesel generator takes maybe 10 to 15 seconds to spin up and produce full power.
Right.
The servers obviously can't survive 10 seconds without electricity, so the UPS battery bridges that gap, providing instantaneous power while the generators wake up.
Exactly. The UPS is designed to provide ride-through capability. However, in this instance, it wasn't a clean, complete blackout. It was a transmission fault. likely a short circuit somewhere on the line that caused a severe momentary sag in voltage before the grid's automated breakers isolated the problem.
The voltage sagged, meaning the pressure of the electricity dropped dramatically but didn't go to absolute zero.
And that dirty, fluctuating voltage confused the sensors in the UPS systems. The inverters and rectifiers inside the UPS, which rely on phase lock loops to synchronize perfectly with the grid's 60 Hz frequency, just couldn't interpret the chaotic signal.
Oh, wow.
Because they couldn't synchronize, they failed to take over the load seamlessly, and the servers crashed.
I think of it like driving a car with a manual transmission. If the engine dies entirely, it's clear what to do. But if the grid just stutters and surges, the data center has to push the clutch in and shift to battery power at the exact right millisecond.
Yes.
But during this fault, the grid stuttered unpredictably, the data center ground the gears, and the engine stalled.
That a highly accurate mechanical metaphor. The synchronization failed.
So Zimbardo asks the million-dollar question, right? Does this mean Dominion needs to incrementally strengthen the entire physical system? Do we need massive new transmission lines? Or let's analyze his logic there from an investor's perspective. If the grid caused the data centers to fail, why wouldn't the utility fix the grid?
Because building new high-voltage transmission lines is extraordinarily expensive, environmentally disruptive, and takes a decade to permit and construct. Bain argued that Dominion already possesses more experience managing this specific type of hyperdense large load transmission than any other utility on Earth. They are already executing baseline upgrades.
So instead of throwing billions of dollars at a problem, he's suggesting a software and coordination fix.
Precisely. Bain stated they are aggressively collaborating with the data center operators, sharing the granular fault data and the lessons learned. The solution isn't to overbuild the physical wires. The solution is for the tech companies to recalibrate the sensitivity of their UPS sensors and optimize their internal mitigation systems to handle those specific voltage anomalies. It is an exercise in optimizing existing infrastructure rather than endlessly overbuilding it.
Dominion simply cannot afford to overbuild for every single contingency. Handling a baseline of 53 gigawatts of incoming demand is already stretching their operational and financial capacity to the absolute limit. They need a bigger balance sheet. They need a larger supply chain footprint. Which brings us to the defensive survival tactic that dominated the next section of the call, which is the pending mega merger with NextEra Energy.
This proposed combination is monumental. We are talking about merging two world-class utility holding companies with a collective 238 years of industry experience, designed to serve millions of customers across 4 states.
I want to focus on the strategic imperative here. Management pitches this as a synergy play, but if we connect this to the 53 gigawatts of AI demand we just dissected, this merger feels less like a casual corporate marriage and more like a necessary evolution to survive the incoming wave.
Absolutely.
Why does raw corporate scale matter so much when you're ultimately just generating and selling electricity in a local region?
Because of how the global utility supply chain currently functions. The lead times for critical electrical infrastructure have become incredibly protracted. Let's take a massive step-down transformer. This is the multi-ton piece of equipment that takes high-voltage power from a transmission line and steps it down to a voltage usable by a substation or a data center.
You can't just order one of those on Amazon.
You certainly cannot. They're custom engineered, often manufactured overseas, and currently have a lead time stretching up to 3 or 4 years. There is a global bottleneck. If Dominion operates alone, they're competing against every other utility in the world for limited manufacturing slots at those transformer factories.
But if they merge with NextEra...
If they combine forces, they create an entity with vastly superior buying power. Their procurement department can approach a manufacturer and order 50 transformers at once, securing priority production slots and significant volume discounts.
I see.
That scale extends to purchasing miles of copper wire, securing specialized construction labor, and crucially, accessing capital on Wall Street. When you're staring down a capital plan requiring tens of billions of dollars over the next decade to physically support the AI boom, being a much larger corporate entity allows you to build, finance, and operate that infrastructure far more efficiently.
So it's essentially pooling their corporate credit scores and consolidating their purchasing departments to wield immense leverage over the global supply chain. But as with any utility merger, it all hinges on regulatory approval. And regulators are historically deeply suspicious of monopolies getting even larger. To grease the wheels, Dominion offered a staggering sweetener, which was $2.25 billion in shareholder-funded bill credits for their customers.
That figure, that $2.25 billion is highly strategic. In a regulated monopoly environment, the utility must prove to the state that a merger provides a tangible, immediate benefit to the captive ratepayer. The regulator's mandate is to protect the consumer, not the shareholder.
How does that $2.25 billion actually manifest? Does a resident just get a check in the mail?
It typically manifests as a direct line item credit on the monthly utility bill over a specified period. The crucial phrase in their proposal is shareholder funded. This means the cost of this credit is borne by the corporate investors, eating into corporate profits, rather than being quietly rolled into some other part of the rate base.
Got it.
It's a direct transfer of wealth designed to demonstrate that the merger lowers the cost of living for the average citizen.
The ultimate decision rests with the state utility commissions. Let's look at the regulatory timelines, because the state-by-state nuances are fascinating. Down in South Carolina, the process seems almost placid. They proposed evidentiary hearings starting December 8, with a final order expected by January 29, 2027. Management specifically noted that the South Carolina Senate, House, and Office of Regulatory Staff have not objected to this timeline.
The lack of political and regulatory objection in South Carolina suggests they are comfortable with the proposed benefits and the integration plan. Evidentiary hearings are essentially formal trials where the utility's executives testify under oath, subject to cross-examination by consumer advocates and industrial customer groups to justify the merger. Moving forward without objections to the calendar is a strong, positive signal.
But Virginia is a completely different battlefield. The State Corporation Commission in Virginia, the SEC, is starting their hearings on November 17. And given the massive data center footprint we discussed, the scrutiny is intense. During the Q&A, analyst Nick Campanella brought up a fantastic point. He cited headlines and rumors circulating in Virginia suggesting certain stakeholders might want an extended review period.
Yes, I caught that too.
My immediate theory when I read that is leverage. Are local players, environmental groups, or heavy industrial users trying to slow walk the merger timeline specifically to extract more financial concessions or policy promises before they give their blessing?
Your theory aligns perfectly with historical precedent in utility mergers. Interveners, which are the third parties legally allowed to participate in the rate case, frequently use procedural delays as a negotiating tactic. If they can drag the hearings out, the utility might become desperate enough to close the deal that they agree to fund a new energy efficiency program or offer deeper rate cuts to industrial users.
But CEO Bob Blue took an incredibly firm stance against this. He essentially drew a line in the sand regarding the timeline.
He did. Blue detailed a recent procedural meeting where the SEC staff in Virginia explicitly stated on the record that they are accustomed to working within standard statutory deadlines. The regulatory staff themselves did not request more time, nor did they claim they lacked the resources to review the merger within the normal window.
Blue argued that the Virginia SEC handles rate cases of immense complexity on strict statutory timelines all the time. His sentiment was clear, right? Changing the rules in the middle of the game and allowing indefinite delays just doesn't make sense given the deep expertise of the commission.
It was a masterful piece of executive communication. Blue was politely but firmly telling Wall Street, the interveners, and the regulators themselves, we expect the state to adhere to the established legal calendar, and we will not be held hostage by tactical delays.
Whether the merger clears the regulatory hurdles on schedule or faces a protracted fight, Dominion doesn't have the luxury of waiting. They still have an empire to run, and they have to build massive new generation capacity immediately. Which brings us to what I consider the most staggering physical endeavor detailed in this entire document. We are leaving the data centers and the courtrooms, and we are going into the ocean. Let's unpack the Coastal Virginia Offshore Wind project, known as CVAO.
This project represents a generational engineering feat. We are discussing the erection of 176 colossal wind turbines, stationed miles off the coast in the hostile environment of the Atlantic Ocean. The stats update provided on the call was extraordinarily granular.
Let's examine the core supply chain numbers, because the sheer scale is difficult to comprehend. The overall project is officially 81% complete. On the manufacturing side, 100% of the nacelles are fully fabricated. 99% of the massive steel towers are finished, with the remaining factions scheduled to be completed in a matter of days. And 85% of the blades were done, with the manufacturer aiming for 100% completion by October.
The completion of those components represents a massive de-risking milestone for an investor. Let's focus on the nacelle. This is the massive housing unit at the apex of the tower that contains the electrical generator, the complex gearbox, and the heavy braking assembly.
Right.
A single nacelle for these offshore turbines is the size of a multi-story house and weighs hundreds of tons. The fact that 100% of these highly complex, custom-engineered components are fully fabricated means Dominion has successfully navigated the most precarious bottlenecks of the global clean energy supply chain.
And they aren't just sitting in a warehouse, they were actively putting them into the ocean. Management reported that 31 turbines are completely installed. The pace is what blew me away. They're averaging just 2 days from jack up to jack down per installation. Let's talk about the physics of that installation process, because it is wild.
The logistics are staggering. They utilize specialized installation vessels. These are not standard cargo ships. When a vessel reaches the precise GPS coordinates in the ocean, it deploys massive mechanical legs down to the seafloor. It plants those legs into the seabed and then uses hydraulic systems to literally jack the entire hull of the ship up out of the water.
So the ship transforms into a temporary fixed steel island.
Exactly. By elevating the hull above the waves, the platform becomes completely stable, totally immune to the chaotic swelling of the ocean. This stability is strictly necessary because cranes are lifting these hundreds of tons nacelles and blades hundreds of feet into the air.
Yeah, you can't do that if you're bobbing up and down.
Right. If the ship were rolling with the waves, pinpoint alignment would be physically impossible. Once the turbine is secured, the ship lowers itself back into the water, retracts its legs, and sails to the next location. Executing that entire jack-up to jack-down cycle in 48 hours is a testament to rigorous operational rhythm.
Those 31 operational turbines represent over 450 megawatts of generation capacity actively spinning today. Management noted that this initial batch already rivals the output magnitude of some of their traditional fossil fuel plants. Furthermore, the final offshore substation, which is the critical hub that collects the power from all the turbines and steps up the voltage for the underwater journey to the shore, will be energized by year-end. That milestone means half of the total project investment is officially classified as in-service.
But this is where the narrative of the earnings call took a sharp pivot.
It did, because despite all that extraordinary progress, the flawless supply chain metrics, and the 2-day installation cycles, they announced both a timeline delay and a cost increase. The final turbine installation is being pushed back by 6 months, moving the completion date to the end of 2027. Concurrently, the total project cost estimate increased by roughly 2%, which translates to an extra $250 million, bringing the new grand total to $11.65 billion.
This is a huge number.
They did note, almost as a comfort measure, that they are still holding $123 million in unused contingency funds.
In the realm of mega infrastructure projects, an unexpected 6-month delay and a $250 million price hike usually trigger a fierce sell-off as investors panic over cost control failures. To understand why the market didn't panic, we must dissect the incredibly detailed mathematical breakdown management provided. It reveals the complex accounting that governs these endeavors.
Let me see if I can map out this math, because there are a lot of puts and takes. The $250 million net increase is actually a combination of 4 distinct factors. First, they added $228 million due to steel and aluminum tariffs.
That is the harsh reality of geopolitics intersecting with infrastructure. When you are building 176 massive steel monopile foundations and towers, you are highly exposed to global commodity markets and import tariffs.
Okay, so a $228 million penalty for tariffs. But then they subtracted a staggering $502 million to account for the reallocation of PJM network upgrade costs. We need to do a deep dive right here. What is PJM? What is a network upgrade? And how does a regulatory decision save Dominion $500 million?
This is a crucial element of grid economics. PJM Interconnection is the regional transmission organization. It's the independent entity that coordinates the movement of wholesale electricity across 13 states, including Virginia. When Dominion proposed connecting thousands of megawatts of new offshore wind power to the onshore grid, PJM determined that the existing onshore transmission network couldn't handle that massive new injection of power without significant upgrades.
More substations, thicker lines, new transformers onshore to handle the ocean power.
Correct. Under standard initial cost allocation rules, the entity causing the need for the upgrade, in this case Dominion's CVAO project, is assigned the cost of building it. However, Dominion challenged this. They engaged in a lengthy regulatory review process, arguing based on the beneficiary pays principle.
Meaning, we aren't the only ones benefiting from these new transmission lines, so we shouldn't foot the whole bill.
Precisely. They successfully proved that these onshore grid upgrades would increase reliability and ease congestion for the entire regional PJM network, not just for the wind farm. Consequently, PJM agreed to reallocate those specific upgrade costs, socializing them across the broader footprint of regional utilities and ratepayers. That regulatory victory removed a massive $502 million burden directly off the CVOW project ledger.
That is a phenomenal win for the project economics. So tariffs cost them $228 million, but the PJM reallocation saved them $502 million. They should be well under budget. But the total cost still went up. What else got added to the ledger?
They added $234 million to cover miscellaneous physical realities encountered during construction. The ocean is an unforgiving environment. Their data revealed that underwater ocean currents at the site were flowing faster than their initial models predicted.
Which means the underwater cables connecting the turbines are subjected to higher shear forces.
Exactly. So they had to spend millions on enhanced, heavier cable protection. Furthermore, they discovered that certain subsea locations had trickier geotechnical profiles, requiring more complex jacking operations for the installation vessels. Finally, higher fuel costs for the armada of specialized ships operating offshore contributed to this bucket.
Let's summarize the math so far. Tariffs up $228 PJM savings down $502, ocean currents and jacking up $234. If you net those three factors out, it's essentially a wash. It's a net reduction of about $40 million. So the actual financial damage, the reason the budget increased by $250 million, is entirely driven by the ticking clock of the 6-month delay.
Your deduction is spot on. They explicitly added $288 million to the budget, specifically to cover the carrying costs of extending the project timeline by 6 months.
They noted that works out to $144 million per quarter in delay costs, which they proudly stated is actually below their historical rule of thumb guidance of $150 to $200 million per quarter for delays.
When you maintain an army of specialized engineers, lease highly specialized maritime vessels, and manage a sprawling global supply chain, time is literally money. Every day the project extends, you are paying daily rates for those ships and salaries for those crews. However, we must view this $250 million increase through the lens of long-term utility economics.
How does the financing structure absorb this?
If we connect this to the bigger picture, Dominion is not absorbing the entirety of that cost increase. They have a financial partner in the CVOW project who absorbs approximately 1/3 of the budget bump based on their equity stake. But the most critical context is the fuel dynamic. Management projects that this wind farm will generate approximately $5 billion in fuel savings for customers over its first 10 years of operation.
Because unlike a natural gas plant that requires you to constantly buy pipelines full of combustible fuel, the wind blowing across the Atlantic Ocean is free.
Exactly. When you contrast a one-time $250 million capital increase against a projected $5 billion reduction in operational fuel costs, the fundamental economics of the CVOW project remain incredibly robust.
I understand the long-term math, but I have to push back here on behalf of the listener. A delay is still a delay. A cost overrun is still a cost overrun. Yet, listening to this earnings call, CEO Bob Blue and the management team were practically taking a victory lap. Why are they projecting such immense confidence and treating this like a massive success story when the finish line just moved back half a year?
The confidence stems from a concept Blue articulated regarding de-risking logic. He made a fundamental argument about the nature of the asset. An offshore wind farm is fundamentally different from a traditional power plant.
Explain that difference. From an engineering standpoint, generating electricity is generating electricity.
Let's contrast it with building a new nuclear facility, like the Vogtle plant in Georgia, or a massive combined cycle gas plant. With those traditional baseload facilities, you spend billions of dollars over 5 to 10 years. You pour the concrete, you build the containment domes, you install the immense central turbines, but you generate exactly zero electricity until the very final day of construction when you flip the master switch.
The risk is binary. It either works flawlessly at the end or it doesn't work at all.
Precisely. If you discover a critical flaw in year 6 of a nuclear build, the entire multi-billion-dollar investment is paralyzed. The CVOW offshore wind project, however, is effectively 176 individual autonomous power plants.
Because every single turbine generates its own power and connects independently to the substation.
Exactly. Because Dominion already has 31 turbines fully installed, with 450 megawatts actively spinning and delivering power to the grid right now, the theoretical proof of concept is definitively proven. The existential risk of the project, Will this novel technology actually function in the harsh Atlantic environment? Can our vessels actually install them? It is heavily front-end loaded and, in management's view, entirely behind them. They know how to fabricate the components. They know the installation ships function correctly. The power is flowing.
So if the technology is proven and the supply chain is delivering, why the 6-month delay?
Blue clarified that the delay is driven purely by mechanical logistics and risk mitigation, not by a fatal engineering flaw. They proactively adjusted the schedule to add weather buffers, acknowledging that late-season Atlantic storms could halt maritime operations. They observed that loading the massive components onto the ships at the Portsmouth Marine Terminal was taking slightly longer than optimally modeled.
And what about the ocean floor conditions?
Crucially, their subsea geotechnical data showed that the final 20% of turbine locations feature significantly harder seafloors. This means the jacking operations, driving those massive ship legs into the seabed to stabilize the vessel, will take longer per installation. They're simply updating the schedule to reflect the physical reality of the ocean floor. It is a calculated logistical delay, not a systemic failure.
That makes perfect sense. So offshore wind is a colossal piece of the puzzle to feed those AI data centers. But here is the inescapable, unforgiving reality of physics. The wind does not always blow. If you are going to guarantee that 53 gigawatts of data centers remain online 24 hours a day, 7 days a week, 365 days a year, you cannot rely entirely on weather patterns. To balance the intermittency of the wind, Dominion is executing what they describe as an all-of-the-above strategy.
And this section of the transcript is where the aspirational goals of the clean energy transition crash headlong into the unyielding demands of modern grid reliability.
Right, because on the exact same earnings call where they are celebrating the installation of over 176 giant zero-emission ocean wind turbines, they also announced that they just filed air permits to build 2 new colossal combined cycle natural gas plants. They are planning the Kennedy Station in South Carolina and the Mount Storm facility in West Virginia, representing nearly 5 gigawatts of new fossil fuel capacity.
To appreciate why they're doing this, we must understand the technology of a combined cycle gas plant. It is not an antiquated boiler. A combined cycle facility is a highly efficient engineering marvel that utilizes 2 distinct thermodynamic cycles, the Brayton cycle and the Rankine cycle.
Break those down for us. How does burning gas in this plant differ from an older plant?
First, natural gas is burned in a massive gas turbine, which is very similar to a jet engine. The expanding combustion gases spin the turbine to generate electricity. That is the Brayton cycle. In a traditional simple cycle plant, the exhaust heat from that jet engine is simply vented into the atmosphere and wasted.
But in a combined cycle plant, they capture that waste heat.
Exactly. They route that intensely hot exhaust gas into a heat recovery steam generator. This boils water to create high-pressure steam, which then spins a second, separate steam turbine, which is the Rankine cycle, generating additional electricity. By capturing the waste heat, a combined cycle plant can generate up to 50% more electricity from the exact same volume of natural gas compared to a simple cycle plant.
It is remarkably efficient engineering, but at the end of the day, it still requires burning millions of cubic feet of fossil fuels, producing carbon emissions.
Well, it does. And the sheer scale of building 5 gigawatts of new gas generation sparked a very targeted question from analyst Carly Davenport during the Q&A. Given the intense focus on managing capital expenditures to protect their credit rating, she asked if this new Mount Storm gas plant represented a surprise addition to their capital budget.
She was basically asking, did you just quietly add a couple of $1 billion in new spending to the ledger? And how did CFO Stephen Ridge defend that?
He was unequivocal. He clarified that this is absolutely not new capital. He explained that these gas plants have always been embedded in their long-term back-end capital plan that stretches into the early 2030s. Dominion has consistently maintained that ensuring reliable baseload and dispatchable power requires these specific gas investments alongside the renewables. Furthermore, he noted the strategic efficiency of the Mount Storm project. Dominion already owns the land, and the necessary high-capacity gas pipeline infrastructure is already built to the site.
Oh, so it's ready to go.
Yes. It is a highly efficient expansion of an existing proven workhorse location, minimizing permitting and interconnection costs.
So we have the intermittent wind, and we have the new natural gas plants. But the all-of-the-above strategy also includes a massive push into grid-scale batteries. They noted a new legislative mandate in Virginia requiring them to accelerate battery storage deployment, and they currently have a staggering $2 billion earmarked for batteries in their 5-year forecast. That represents roughly 3% of their entire capital plan.
The battery component is a fascinating frontier for the utility. When asked for a deployment timeline, management detailed that there will be a state-sponsored technical conference this fall to discuss the complex permitting, supply chain, and feasibility issues surrounding grid-scale batteries. The results of that conference will directly inform Dominion's next Integrated Resource Plan, or IRP.
An IRP is essentially the master blueprint that a utility submits to regulators, outlining exactly how they plan to meet energy demand over the next 15 years, right?
Yes. And by relying on the technical conference to shape the IRP, management essentially admitted that grid-scale battery storage is still a nascent capability for them. They need to build out an entirely new pipeline of supply chain relationships, engineering standards, and development expertise for batteries, very similar to the learning curve they navigated when ramping up utility-scale solar a decade ago.
So we have the wind, the gas, and the batteries. But to truly understand the foundation of grid reliability, we cannot forget the undisputed heavyweight champion of baseload power, which is nuclear energy. Dominion provided a brief but potent update on the Millstone nuclear plant located in Connecticut. They are currently awaiting a decision from the state regarding a zero-carbon request for proposals, or RFP. But the financial numbers they shared regarding their existing power purchase agreement, the PPA, for Millstone are absolutely stunning.
The mechanics of that power purchase agreement provide a masterclass in utility risk management and consumer protection.
They stated that the single nuclear contract saved Connecticut customers over $300 million this year alone, and is projected to save consumers over $900 million over its 10-year lifespan. How does a single power plant generate almost $1 billion in savings?
It comes down to the mechanics of wholesale energy markets and the concept of financial hedging. A power purchase agreement is a long-term contract where the utility agrees to buy electricity from the power plant at a fixed, predetermined price for a decade or more.
So no matter what happens in the world, the price of the nuclear power is locked in.
Exactly. Now, consider how wholesale electricity prices are typically set. They are largely dictated by the spot price of natural gas, which fluctuates wildly based on winter weather, geopolitical conflicts, and pipeline constraints. Back in 2019, when this Millstone PPA was negotiated, the fixed price they agreed upon was actually slightly higher than the prevailing market expectations. Some critics argued it was too expensive.
But then the market shifted. Global natural gas prices spiked due to inflation and geopolitical crises.
Precisely. The wholesale spot market for electricity skyrocketed. But because the customers in Connecticut were insulated by this fixed-price nuclear PPA, they didn't suffer the price shock. The locked-in rate of the nuclear power was so much lower than the new, inflated market price of gas-fired power that it effectively acted as a massive financial swap, generating hundreds of millions of dollars in savings against the spot market. It perfectly illustrates how nuclear power, with its stable long-term operational costs, dampens economic volatility for consumers.
So taking a step back, what does this diverse portfolio actually mean? I want to pose this question for you, the listener, who might be experiencing a bit of cognitive dissonance right now. Why is a company spending nearly $12 billion to construct a zero-emission wind farm in the ocean while simultaneously pushing for regulatory approval to build 5 gigawatts of fossil fuel gas plants, while also managing nuclear reactors and experimenting with $2 billion in batteries? It feels like they are driving in 4 different directions simultaneously.
It requires us to move past ideological energy debates and employ critical first principles thinking about the physical, unyielding realities of the electrical grid. The fundamental constraint of modern electricity is that we cannot yet store it efficiently on a massive grid-wide scale for extended periods. Therefore, as we established earlier, supply must exactly match demand every single second of every single day.
Hence the necessity of this holistic engineering balancing act. You cannot power a modern society with just one tool.
Precisely. You must curate a diverse portfolio based on the specific physics of each technology. You need intermittent renewables, like the CVAO offshore wind project, because, once built, the fuel is clean, carbon-free, and most importantly, free. It drives down long-term marginal costs.
But the wind doesn't blow at command.
Right, so you pair that with baseload power, like the Millstone nuclear plant. Nuclear provides a massive, unshakable floor of constant, reliable energy that runs 247 for 18 months at a time without refueling.
And crucially, you need dispatchable power to handle the spikes.
Exactly. Dispatchable power means you can turn it on and modulate its output exactly when you need it. When Dominion hits one of those 9 record-breaking demand days we discussed in the first segment, and it happens to be a sweltering, windless evening where the ocean turbines are still, they need a power source they can ramp up to maximum output with the flip of a switch to prevent the grid from collapsing. That instantaneous heavy lifting capability is what the combined cycle natural gas plants and the $2 billion in battery storage provide.
Managing this diverse, complex portfolio of generation assets while simultaneously financing it without breaking the balance sheet is incredibly difficult, which is why management made sure to briefly highlight their recent regulatory success in South Carolina. They noted their fourth consecutive successful base rate case settlement in that state. They are using that track record as evidence to Wall Street that they possess the regulatory competence to navigate this massive transition smoothly.
It is an incredible high-wire act of engineering, finance, and regulatory diplomacy.
We have covered an immense amount of ground in this deep dive. We started by exploring how Dominion Energy is fortifying its balance sheet to survive an unprecedented, truly historic surge in demand driven by 53 gigawatts of AI data centers. We examined the strategic imperative behind their multi-billion-dollar corporate mega merger with NextEra, framed as a desperate bid for the scale required to navigate global supply chain bottlenecks.
We also dissected the gritty, mechanical realities and the complex cost mathematics of building the CVAO offshore wind project, analyzing how they saved $500 million on PJM upgrades only to spend it on tariffs and ocean currents.
And finally, we unpacked the sheer engineering necessity of balancing the grid within all of the above strategy, utilizing the high-efficiency physics of combined cycle natural gas, the emerging technology of grid-scale batteries, and the unshakable economic foundation of nuclear power.
It is the ultimate blueprint of a physical world, straining, adapting, and expanding to accommodate a boundless digital revolution.
And that leads me to a final thought I want to leave with you, the listener, a provocative question to mull over long after this analysis ends. Throughout this entire earnings call, every single initiative we discussed, the massive capital investments, the sprawling grid upgrades, the $12 billion ocean wind farm, the new 5-gigawatt gas plants, it is all heavily predicated on one core, foundational assumption, the infinite, exponential, and permanent growth of AI data centers in Virginia.
That assumption is the absolute bedrock of their entire multi-decade growth thesis.
But what happens if the AI bubble bursts? Or perhaps more likely, what if the tech industry achieves a breakthrough in decentralized edge computing, where they figure out how to process these massive AI workloads on devices locally, and they realize they don't actually need these massive, hyper-concentrated, power-hungry, centralized hubs anymore? If the tech world changes its mind overnight, as it has done so many times before, how easily can a utility company pivot a 20-year, multi-billion-dollar physical infrastructure plan? You can rewrite a software algorithm in an afternoon. You cannot simply delete a monolithic concrete power plant or a high-voltage transmission line.
The physical infrastructure is far, far less forgiving than the cloud. Once the steel goes into the ground, the consequences are permanent.
Exactly. The digital cloud might feel weightless, but the infrastructure powering it is bolted to the ocean floor. Thank you for joining us on this deep dive. Keep questioning the unseen forces shaping the physical world around you. We'll catch you next time.